Greetings, everyone, and welcome to today's GT News webinar, Cash Management in 2015, the Trinity of Challenges, proudly sponsored by State Street Global Advisors. I'd now like to hand you over to our moderator for today, Ms. Yang Felipe Butler, Head of U.S. Cash Business at State Street Global Advisors. Welcome, Yang, and thank you for joining us today.
Thank you for joining us today for Cash Management in 2015, a Trinity of Challenges. I'm Yang Butler, Head of the U.S. Cash Business, and it's my pleasure to serve as moderator today. A quick note before we get started, you can download the slides for today's call on the website, so hopefully you have those in front of you. And to repeat, you may also submit questions at any time during the webcast on the lower right corner of your screen. And we will respond to these during the Q&A session at the end of the call. But first, we'd like to take a poll to learn what regions you're calling from. Please respond to the polling questions in the box located at the right-hand corner of the screen. And please click the appropriate region and be sure to hit the Submit button on the lower right. Thank you. So as many of you are aware, in the years since the global financial crisis, we have seen sweeping changes in the operating environment for cash. Going to 2015, cash investors are faced with what we refer to as a trinity of challenges. First, new landmark regulatory reforms. Second, historically low interest rates. And finally, a shortage of high-quality short-term securities in the market. In our previous webcasts with GT News, we've discussed how these challenges impact the operating and core buckets for cash investing. In today's call, however, we will do a deep dive into the third bucket, strategic cash. But before we do that, we'd like to provide some insight into our overall expectations for the cash market in 2015. On our call today, I'm joined by Steve Meyer, CIO, Global Fixed Income, Currency, and Cash. Steve will provide an outlook for cash management in 2015. Then we'll shift to Tom Connolly, Vice President and Senior Portfolio Manager. Tom will discuss liquidity constraints and opportunities for higher yields in short-duration products in the coming months. Before I turn the call over to Steve, we have another polling question for the audience. Again, please respond by clicking in the lower right corner on your screen. Do you currently bucket your cash into discrete pools to meet different objectives? Yes or no? And if yes, please click which bucket to use, daily operating, core, or strategic. In the meantime, let me turn it over to Steve to give an overview of the cash markets for 2015.
Terrific. Thank you, Yang. And good morning, good afternoon, good evening, everyone. Certainly the global cash markets have been interesting and somewhat challenging since the outset of the global financial crisis, beginning in either 2007, 2008, depending on your perspective. We've seen extreme low levels of official rates throughout the developed markets. We've seen an unprecedented amount of central bank innovation to support growth and address deflationary pressures. We've seen regulatory adjustments on a scale not experienced in our lifetimes, certainly not in our professional careers. We've endured an extended period of global market repair, which is ongoing and inconsistent and at different phases around the world. Please take a look at the slide that's in front of you on your screen right now. This is a terrific slide with several insights and really illustrates some of the very relevant points that we're thinking about today. Well, firstly, you look at the prior predictable pace of successive U.S. rate hikes in 2004 to 2006. Remember, we had 17 consecutive 25 basis point rate hikes. This time around, I don't think you'll see the magnitude of those hikes to be anywhere close to 425 basis points, and I don't believe they'll occur at every meeting. Also, look at the magnitude of prior rate hikes just in basis points. As I said, 425 basis points in the U.S. And similar hikes and tightening in the U.K. and Europe. Less so in Japan, which is also noteworthy. Look at the dramatic cuts that we experienced following Lehman's default in 2008. Look at the stability of extremely low rates following the global financial crisis' onset, and look at the long process of repair that we've endured, again, 6 years and counting. Note the policy mistake by the ECB in 2011, where they had 2 rate hikes and then some quick cuts following that as the economy slowed there. Again, those are the issues that I think are foremost on the minds of central bankers today. They don't want to tighten too quickly, and I do think all manner of central banker will be more inclined to to be patient and hike in a very measured way. Look at the negative deposit rates we're now experiencing in Europe on the far right-hand side at negative 20 basis points in depot rates. And look at the extreme policy in Japan for a prolonged period to combat deflation, really going on 2 decades. And that's another thing that's foremost on the minds of most central bankers around the world, is to avoid the same plight of deflationary cycle and very, very modest levels of growth and rates. All these factors combine to remind us that we're living history, and that the markets will continue to be interesting and challenging in the coming years as well. Now, our outlook for the cash markets around the world is a balance of both optimism and reality. We'd like to think of ourselves as optimistic for continued economic improvement and eventual rate normalization across the globe, but we're also realistic and recognizing the process of repair is ongoing. It's uneven in scope around the world, and there are a number of events that could certainly derail the global or local economic recoveries. The recovery in the global markets today is still very, very fragile.
So, Steve, given all of that, as the Fed prepares for a potential rate hike in 2015, can you see the U.S. markets decoupling from a global slowdown?
I can, Yang, and that's a great question. Certainly the U.S. is not an island on itself. We're part of an integrated global economy. But we're a pretty sizable country and with a sizable market. So I do think you'll see divergence in terms of a decoupling of both the U.S. and the U.K. market from the pace and policies that we see in, say, Europe and Japan. This process, as I described earlier, is challenging because of the fragility of the global economy. But we do see, again, strength in the U.S. markets, strength in the U.K. markets. We don't see that carrying over into Europe and Japan. And again, we're at different phases of economic repair and global repair. If I had to guess, I'd say the U.S. is in a repair cycle that is probably in the magnitude of 10 years, and Europe probably closer to 20 years, and certainly in Japan it's going on for 2 going to 3 decades at this point. Economic policy will ultimately drive monetary policy, which is why, again, we focus on this divergence so closely.
So let me switch over to the regulatory challenges, Steve. How do you see the regulatory environment impact liquidity in the short term?
Yeah, another great question, Yang. Thanks for that. So when you think about liquidity, first of all, it's a relative term, but also liquidity deals with the ability to buy and sell securities or products or goods at a reasonable price, at a reasonable expense, in a reasonable period of time. Let's take the second part first. The ability to sell securities into the market. The secondary market liquidity dynamic around the world is significantly altered, and I think at all costs, investors want to avoid being a forced seller of product in a liquid market at all costs. Banks today are discouraged from proprietary trading or even principal positioning. They're unable to do so due to several regulatory initiatives: the liquidity coverage ratio, Basel III, the supplemental leverage ratio, etc. Due to the increase in risk aversion, banks are also unwilling to position paper on a proprietary basis. They've moved to more of an agency execution model today, which is less reliable for secondary market liquidity, particularly in a stressed market. We also look at dealer inventories of securities, which are down about 70 to 80% from their peaks in 2008. And this involves all manner of instruments: U.S. Treasuries, sovereign debt, money market instruments, corporates being both investment-grade and high-yield securities, and asset-backed securities as well. Those smaller inventories, I should also say, reflect that it reduces the availability of repurchase agreement product for cash investors, which has been a core staple of money market fund investing. Now, regarding supply, the regulatory changes have also disincented a number of issuers of paper from raising less reliable short-term, what's referred to as wholesale funding in the marketplace. They've also been encouraged to extend their liability maturities across a diversified source of funding. And again, that has an impact on product available in the very short end of the curve, inside of a month, and certainly inside of 3 months. Money market reform also supports investors holding more on-hand liquidity and very short maturity. So look at the U.S., for example. There's a requirement for registered 2a-7 funds to have 10% overnight and 30% one-week liquidity. So there is a challenge where there's a disconnect between the issuers needing longer-term funding while the money market funds need to stay liquid based on regulatory changes there.
With all that context, how would you suggest positioning cash portfolios as we head into 2015?
Well, in terms of traditional cash, I still think we need to adhere to the three core objectives: the safety of principal, liquidity, and yield relative to the mandate relative to risk tolerance. So from a credit quality standpoint, only buy strong credits and structures that you understand. It's interesting to note that the regulatory changes and issuer preferences may have pushed investors into marginal credits to find yield and capacity, but we certainly resist this at all costs. My comments around secondary market liquidity certainly bears mentioning from a cash perspective, in that you want to make sure you have enough on-hand liquidity, natural liquidity associated with a laddered portfolio and a roll down of maturities, but also core cash as a key component of any cash portfolio. Again, although the securities, the issues out there are scarce and relatively expensive from a yield standpoint, they are certainly continue to be required as core holdings of the funds. And I'd say that applies even when rates move higher. In terms of U.S. And UK interest rate sensitivity considerations, again, we think that rates will move higher in by both the Fed and the Bank of England in the latter part of 2015. But again, I think those hikes will be well telegraphed, well priced in, and very gradual in nature. So I don't think you need to be so concerned about the amount of interest rate sensitivity in these portfolios. We look abroad. We look at Europe. I'd say we run the risk of piercing the negative yield barrier in Europe. You look at negative deposit rates, again, consistent with ECB policy at negative 20 basis points, create some real challenges there as well. I'd say the sweet spot for short-end investors now, again, is in that strategic cash, that ultra-short bond fund space of 1 to 3 years, where there's product availability associated with yield as well.
Thanks, Steve. Next, we'll hear from Tom Connolly. But I'd like to, before we do that, I'd like to do a last poll before I turn it over to him. So the final polling question is what are your expectations for short-term interest rates in 2015? Rise significantly, approximately 100 basis points, rise moderately, around 50 basis points, or remain relatively unchanged. Let me turn it over to you, Tom, as we wait for the results here. Given the environment that Steve's just described, where do you see opportunities within strategic cash investment?
Yeah, thanks, Yang. I'd like to, touch upon a few key points as they relate to how we think about investing strategic or non-operating cash here at State Street Global Advisors. As has been previously mentioned by both Yang and Steve, due to the regulatory factors, there is currently a very high cost of liquidity in the extreme front end of the yield curve, with the supply and demand imbalance that Steve mentioned, where short high-quality assets trade at extremely low yields. Recently, we've all witnessed T-bill rates hovering just above zero, and short credit-related products such as commercial paper and certificates of deposit really aren't much cheaper by comparison. In fact, it's getting very hard to find high-quality bank liabilities for money funds inside of 3 months at all. Prior to the crisis, or even a few years ago, I would say, a couple of years ago, you would come in the morning and you would see, Bank X that offers paper in every single maturity from, 1 month to 12 months, and you could customize exactly where you wanted to place your money and at what rate. Today, it's a little bit different. We come in and we see bank paper only offered maybe in 4s through 6s, and then maybe again in 9 months through 12 months. That's really the only place that the bank wants the liability. As Steve mentioned, it's cost prohibitive for them to take the money any shorter than that. So with this in mind, we'd urge cash investors to really take a good look at their liquidity needs in order to minimize the yield drag that is associated with the access to 2a7 style liquidity. As Steve mentioned, that's a full 10% overnight and 30% within 7 days, which is, that's plenty of liquidity. And I would expect that many in prime money funds maybe don't need that type of liquidity. Some of course do, but if appropriate, a slightly more aggressive approach to investing cash may make sense where liquidity is still important, but it's maybe a secondary concern. We like to think of our strategic cash at SSGA, the philosophy really is one of longer cash as opposed to shorter fixed income. And by that I mean we still focus on preservation of capital. It's still the primary objective. We construct strategic cash portfolios with the same credits and structures in the case of ABS that are held in our prime 2A7 money market funds. So we really strive to add return by extending duration and or maturities of these bonds, primarily corporate bonds and asset-backed securities for their yield characteristics. By focusing on corporate credits rated A3, A- or higher, we are effectively only going really one notch lower in credit than what the SEC allows money funds to do. If you think about A1, P1, where the bulk of money fund assets are invested in as far as a credit bucket, that loosely translates to a longer-term rating of A2A in general. So by going to A3, A-, you're really only going one notch lower than what a money fund allows, 97% of their assets to be invested in. And the SEC allows a small portion of A2, P2 paper, which is, generally A3, A- or down to even mid-triple B. So in most environments, the extension of duration and maturity will help investors realize increased yields. It stands to reason that an investor would be compensated for the increased risk he or she takes on. So most of our strategic clients, cash clients, I would say, think about duration in one of two buckets. The first example generally keeps duration no longer than about a half a year, while the other generally uses a 1 to 3 year cash benchmark, either treasuries only or a government credit type of benchmark, with duration obviously in that space right around 2 years. So the biggest difference for us is how we structure the portfolios is the use of floating versus fixed rate debt. At this point, I'd like to use a real world example of a corporate credit that is pretty popular with most short-term investors to show you what the yield curve looks like for both fixed and floating rate coupon examples. So the chart at the top left shows the credit curve for a floating rate note that floats quarterly, resetting off the 3-month LIBOR rate. The red line on the bottom represents the spread to LIBOR, while the blue line represents the all-in yield, assuming the 3-month LIBOR is at 23 basis points, where it is today and where it has been, unfortunately, for quite a while. So the first data point is a June 15 maturity. So this bond is actually well inside of money market eligibility at a 7-month maturity. This bond would be offered at a spread of LIBOR plus 0 or LIBOR flat. So your yield is only 23 basis points, the yield on LIBOR. As you extend maturity, the spread improves from about 5 in the December 2015 bond to 18 for the September 2016 bond. The spread jumps all the way to 30 for a September 17th maturity. And just yesterday, this credit's close competitor issued a 3-year maturity at LIBOR plus 37. So by extending maturity, strategic cash investors can move from that yield of 23 basis points on a 7-month bond, which is really still considered pretty long in the money market space these days, all the way out to 53 basis points for a bond just under 3 years. The chart on the bottom right is the fixed rate bond by the same issuer with real examples. These data points are actual bonds, as they are in the floating rate example. So in this case, the red line on the bottom represents the spread to the matched maturity U.S. Treasury bond. The blue line, again, represents the all-in yield. And this is representative of yields, the Treasury market, the yield curve as of November 6th, so a couple weeks ago. You'll notice that the spread curve appears a little flatter in spots compared to the floating rate curve, but the yields are much higher. This is because the Treasury curve is very steep between 1 and 3 years. As you know, really that's where the Fed starts to, the Fed rate hikes are being discounted in the market, and that part of the curve. So the September 15th money market eligible bond yields about 35 basis points, while the bond is close to 3 years, yields almost 1.5 at this point. So the differences in yield between fixed and floating rate bonds represent the risk that a fixed rate investor is compensated for by accepting that duration add. The floating rate bonds all reset their coupons every 90 days. So this really reduces the interest rate risk for the investor. If there is a sudden change in LIBOR, which we don't expect for the reasons that Steve mentioned prior, we think it's highly unlikely that the Fed would not be very transparent in their plans for how they go about their rate hikes and when they do so. The time before this coupon adjusts is very minimal, so that gives the floating rate holder much less price volatility versus the fixed rate bond. So through the use of floating rate notes, we can structure short duration portfolios with durations in that, say, a quarter to a half of a year range with substantial yield pickup versus a prime money fund alternative. I would say having said that, even though the floaters give you pretty good price protection against rising rates, a portfolio built around short rates in that 1 to 3 year range has been a pretty steady favorite of short-term investors for many, many years. And while there may be periods of underperformance in that strategy versus a prime money market fund, an investor who sticks with this strategy over the medium term should generally realize decent outperformance versus short duration alternatives. Having said that, I would say, right now, given the Fed and, given the fact that the market is probably discounting a little bit less than what the Fed has told us they expect rate hikes to look like as far as the dots, the environment for fixed rate may be a little bit dicier right now and a little bit more risky than sticking with that floating rate example. But those are really the building blocks of and how we go about constructing portfolios in the strategic cash space.
Thank you, Tom. Given our audience is fairly split between staying relatively unchanged for interest rates next year, it looks like 52% expect that, and 44% expect a rising moderately for next year. Steve, if I can ask you, how do you expect the Fed to go about raising rates? And do you expect a measured pace, or will there be any surprises?
Well, I don't think they'll anticipate providing the market with surprises. I think they need to be, again, very communicative about certainly the first rate hike to reduce the risks associated with a rate hike and the market volatility that may follow. You raise some good points, though, in terms of the balance between those expecting rate hikes and those not expecting rate hikes. As I said earlier, the global economy is fragile. The U.S. market is in an island. We saw last year how the factor X can creep into even the best laid plans. Look at the polar vortex that generated a negative GDP growth in the first quarter of the year. There are things that could take the recovery off course. However, we have seen, again, this long process of repair bearing fruit, the balance sheet repair on the part of banks, the gains that we've seen in the employment picture in the States. Again, inflation is still below the Fed's preferred target, but again, it's stabilized at slightly over 1%. So, my expectations are, all things considered, for the U.S. economy to continue to improve. It's not going to be a 5 to 6% GDP growth situation, but closer to 2.8 to 3%, I think, in 2015, which will be enough to move the Fed to eventually start moving some of this policy accommodation and move rates slightly higher in the latter part of the year.
Thanks, Steve. Thanks, Tom. We'd like to open it up to questions at this point to the audience. Again, please submit your questions in the lower right-hand box on your screen. And it appears like there's a follow-up question for Steve regarding rates. How should investors deal with potential volatility in the short-term markets as the Fed communicates its actions?
Well, I think you could certainly see volatility. We got a taste of that with the temper tantrum in 2013. We've seen a lot of volatility actually in October, more associated with economic developments, concerns around Ebola, some geopolitical concerns as well in the marketplace. I do think that investors should prepare themselves for increased volatility, whatever the source. In terms of, again, Fed monetary policy changes providing a catalyst for increased volatility, I think that you'll see some of that, but again, I think the Fed's going to be very careful to be communicative around the first rate hike, and I think they'll be similarly communicative on subsequent rate hikes at a gradual pace, depending on data and the market outlook.
This one is for Tom. How can asset-backed securities benefit a short-duration portfolio?
Sure. Well, here at SSGA, we're big proponents of asset-backed securities, and we do use them when appropriate in strategic cash portfolios. We generally, or really always, stick with AAA quality assets, and we stick also with what's commonly referred to as the plain vanilla collateral types in the asset-backed space, and that's credit card bonds, auto-related paper such as loans, leases, and floor plans. Some equipment paper, some of your better structured, guaranteed student loan paper. So we really feel that the use of asset-backed securities adds to the diversification of a portfolio between corporates and agencies and treasuries, and we feel that adding asset-backed makes a lot of sense. It really helps the portfolio liquidity. It helps the portfolio return, and we like the liquidity on the bonds as well.
Thanks, Tom. And I think this next one is for either one of you. Looking ahead to the future reform in a more normalized interest rate environment, do you forecast a larger spread between government and Treasury funds compared to prime funds?
Yeah, maybe I can take a stab at that, Yang. Certainly, I do think as we move closer to money market reform, you'll see the potential for outflows from prime institutional funds that are about $900 billion in size, but see perhaps 25 to 30% outflows into government-only and Treasury-only funds. I do think you'll continue to see government and Treasury product trade expensive, meaning relatively low yield, irrespective of whether the Fed raises the official rates. I do think credit will cheapen up. It'll still be probably in decent demand inside of 3 months, but a little further out the curve, I think that you'll see credit spreads widen and an opportunity for yield pickup for investors willing to take on that, again, market value construct or accounting treatment associated with the prime institutional funds.
I think we've got time for just one more quick question here. And this is for Tom. What are some of the risks involved with investing cash with a longer-term horizon versus a traditional money fund, and what are the mitigating factors?
Well, aside from interest rate risk, which I think we covered, the differences there, which are, a little bit more substantial than a money fund, I would say other risks are, one risk that not all short-term investors think about is spread duration risk, especially as it pertains to a floating rate portfolio. It's very easy to have a very short duration through the use of floaters, but at the same time have a very long spread duration. And an example would be if a portfolio, owns 5-year paper as opposed to something shorter, say 2-year maturity paper. So if credit spreads widen on a bond, so regardless of interest rates rising won't hurt a floater that much for reasons we've discussed prior. However, if credit spreads widen, a 5-year bond will be hurt much more in price than a 2-year bond would or a 1-year bond would. So that's an important metric that we always look at SSGA when we run these portfolios. And we generally like to keep that metric, that spread duration risk, somewhere between 1 and 2 years. Again, with preservation of capital and a high degree of liquidity as an underlying theme, we don't find it appropriate to just pack in as much yield as we can in these portfolios. So we do look at that metric for risk. Another risk that's been mentioned, that's come up a couple times on this call, is just liquidity risk. With the regulatory changes, the liquidity on some of this paper is not what it used to be at all times. Generally speaking, we own shorter paper and higher quality paper, so we are comfortable with the liquidity. Anything, generally when there's a liquidity event in the market, lower rated paper and longer paper would be more impacted than shorter, higher rated paper, which we own. But having said that, we have seen some clients go to somewhat of a more laddered portfolio where, for instance, they may have half their assets in the portfolio equally split between 3-month periods between 0 and 1 years, and the balance of the portfolio is evenly split between the 1 and 5-year buckets. So in that way, that's for a portfolio and for a client that knows they're going to have periodic needs for liquidity. They're not sure when, they're not sure how much, but they always know that given the ladder, they're never going to impact their longer-term bonds too much, and the price hit during a bad liquidity market won't be so severe, and the liquidity is almost built in for them.
Thanks, Tom. So there are a number of other questions that just came in that we did not get to, but we'll be sure to address those by email directly with the submissions. So thank you again for joining State Street Global Advisors today for this webcast. It's important to engage with your investment managers to determine a strategy tailored to your cash flows. We also encourage you to reassess your investment policy statements and bucket cash according to your specific needs. With an optimized cash management strategy, you can make your cash work harder. We invite you to read our piece, The Guide to Investing Strategic Cash, on our website, which is you can see on the slide there. If you have any further questions after this call, please don't hesitate to contact us. We appreciate your participation and have a wonderful day.